Okay, hello ladies and gentlemen, and welcome to this webinar brought to you by City Index. This is How to Become a Trader, webinar 3 of 6. Today we're going to talk about technical and fundamental analysis. So I'm going to be giving you a broad introductory outlook and overview of the tools that I use in terms of the technicals as well as the fundamentals, and then we're going to be talking about entries and exits purely from a technical perspective as well as risk management. So we're going to be talking about all of that today, and then hopefully next week in this six-part series, I'm going to be tying a lot of this together to give you actual approaches and strategies to trading in the financial markets. So again, this is webinar 3 of 6, and my name is James Chen. I'm the Chief Technical Strategist at City Index Group. Just as an overview of today and recently in the financial markets, we saw today extremely heightened volatility, especially in the equities markets. If you saw that, especially down in the S&P 500 as well as the FTSE and all of the other indices, we saw, they were hit particularly hard. The S&P at one point was down over 2%. Now we're seeing a little bit of as we go into the close, a little bit of a bounce, so that's a good thing. But essentially, this heightened volatility is a good thing. It can be a good thing. It gives you opportunities to trade. Now, you should be able to go long, both go long and go short, or know how to do either or, as well as have your risk management in place. If you can only go long and you don't take care of your risk management, then you're probably, at least today, not doing so well in terms of the trading. So again, these markets now, in terms of the volatility that we're seeing across the board, especially in the equities markets, provides opportunities to trade. And again, you need to be able to know how to go long and short, or be comfortable in doing both, as well as having strong risk management skills. And I'm going to talk about all of that today. The equity markets were hit particularly hard, as I mentioned. What came out today was the PPI, the Producer Price Index in the U.S. It was down 0.1%, which gives some indication of a risk of deflation, and that brought the U.S. dollar down, as well as it helped bring the U.S. dollar down, as well as the equity markets. Of course, in other news, the ongoing economic troubles in Europe. We have crude oil continuing to hit long-term lows. And, of course, we also have other news, including the protests in Hong Kong and even Ebola, second transmission in the U.S. There was a nurse down in Texas who transmitted Ebola from the prior patient. Now, you may not think all of this really matters in terms of the financial markets, but in some ways they do. So a lot of what's going on in the markets, really has to do with what's going on around the world and the news and the fundamentals, etc. So we're going to talk about all of that in a minute. So let's move forward real quick. And hopefully you could all hear me. I see that I may be going in and out, and if I do, please bear with me. It may be the platform, the webinar platform I'm using. If you have any questions during the course of this webinar, please feel free to type them into the questions window, and I'll be more than happy to answer any questions that I see. Okay, so let's move forward real quick. Very quickly, quick disclaimer. Financial trading carries a high level of risk to your capital with the possibility of losing more than your initial investment and may not be suitable for all investors. Ensure that you fully understand the risks involved and seek investment advice if necessary. Okay, let's move forward. That's in my prior two webinars, I gave an introduction to myself. You could see the recording. It's all on our website at cityindex.co.uk. All of the recordings are there, and I give a brief introduction to myself, so I'm not going to do that today. But again, all the recordings are available. They're going to be available the day after each webinar, so feel free to go ahead and check those out when you have some time. Okay, so the agenda, once again, I'm just going to quickly go through this as I've gone through this in the prior webinars. The first webinar was an introduction to trading the financial markets. I gave a broad overview of stocks, indices, commodities, and currencies, and how to go about looking at them, how to go about trading them. And then in the second webinar, which was last week, we talked about the trading platform and the tools that I use. You could see that again on the recording. That talks about the Advantage Trader, Advantage Web, as well as MT4, and I'm going to be using some of those tools as well today to give you an outlook on what I see in terms of what I use in terms of the technical and fundamental tools. And this week, today, again, I'm talking about technical and fundamental analysis. These are both really big subjects, so to really handle them in one webinar is pretty ambitious. So I'm going to be going over a very basic overview of these, and then over the next 3 webinars, over the next 3 weeks, I'm going to be talking more about how to tie them together and actually trade with these tools using technical and fundamental analysis in cohesive strategies and approaches to trading. So, but today, again, I'm going to touch upon the tools and the techniques that I use with respect to technical and fundamental analysis. I'm going to talk about entries, exits, and risk management in particular. And then next week we're going to be talking about, again, I'm going to try to tie everything together more from a technical perspective. I'm going to be talking about strategies that I use, the techniques that I use to actually trade when I see opportunities. And then after that we're going to go into more advanced trading strategies, intermediate trading strategies that, once you've gone over the hump of learning the basics of trading, the basics of technical and fundamental analysis, we're going to be talking about more advanced methodologies. And then lastly, we're going to be talking about, on the very last webinar in this series, we're going to be talking about trading plans, which are very, very important, money management, and trading psychology, all of which are essential to trading successfully. Okay, it's not just about entries and exits. It's not just about the little lines on your charts or the buy and sell button. It's about a lot more than that. And the 6th webinar, the last webinar in the series, we're going to be going over some of the most overlooked and perhaps some of the most important aspects of trading successfully and trading effectively. So we're going to do all of that on the 6th and last webinar. So that is the agenda in a nutshell, and let's get started. Okay, so I'm going to start off with fundamental analysis. Now, I'm known as in the industry as a technical analyst, but I cannot disregard fundamental analysis. It's what really moves the markets. When you talk about trading, you really want to, you want to be able to react to the markets. What the markets do, you want to be able to take the opportunities you see, etc. But what really drives the markets are the fundamentals. I mean, technicals do as well, but the fundamentals are really what drive the markets in terms of what makes this stock go up or down, what makes this index go up or down, as well as the currencies and commodities. So it's all about what are the driving forces behind these market movements and how we could take advantage of these driving forces. And then we use the technical analysis to pinpoint our entries and exits, to place our risk management, and to do the actual trading. So, I look at it from a broad overview, starting from the fundamentals, and then I drill down into the technicals. And as we go into more advanced strategies over the next few weeks, the drilling down part is going to take a front seat, because really what I'm going to be talking about is, first of all, you want to be able to take a broad overview. So even if you're just trading from a technical perspective, you want to take a broad overview. You look at the longer-term charts, what's going on with the longer-term trend, and then you want to drill down into shorter and shorter time frames and get really granular. And that's the way I trade. And it really it applies to fundamentals and technicals as well. I see fundamentals as the broad overview, and then drilling down into the actual entries and exits, I'm going to be using my technicals. Okay, so just some quick notes about fundamentals. There are different analytical factors for each market or instrument traded, obviously. Okay, so the fundamentals for the S&P 500 or the FTSE are going to be very different. Well, first of all, they're going to be different from each other. The FTSE fundamentals and the S&P fundamentals are going to be different from each other, simply because they're talking about two different countries' markets. But beyond that, you talk about the currencies, you talk about commodities. The fundamentals on all of these are, they could have some unifying factors, but essentially they're all different. Okay, so if you study Apple's fundamentals, and then you study the S&P fundamentals, okay, they're necessarily going to be very different. How so? Well, I'll get to that in a second. Fundamental analysis is good for choosing markets to trade. Okay, so I see something fundamentally going on. Okay, some strong fundamental force going on. That's gonna be a good deciding factor on what I'm gonna be trading. Okay, fundamental analysis is also good for determining longer-term directional bias. Okay, so for example, we see what's going on in the indices. Okay, so from a long-term perspective, those things I just talked about in the beginning, talking about first of all, the risk of deflation today with the PPI. We talk about the end of QE, quantitative easing. We talk about troubles around the world, economic troubles around the world, crude oil. All of these things combine. They give us some sort of directional bias to where the equities may go, or where the currencies may go. So they give us some. First of all, they allow us to choose what's a good market to trade, and then they give us a good directional bias. Okay, now what is fundamental analysis not good for? It is not particularly good, or I would argue not good at all, for determining trade entries, exits, or risk management. So, for example, you see, we talk about crude oil going to long-term lows and continuing to hit, further and further lows. Now, is that good for finding an exact entry into your euro-dollar trade, or into your, into your equity trade? I would say absolutely not. So, in terms of finding the overall picture, fundamental analysis is good. It's not good for pinpointing entries, exits, and risk management, and that's what I use technical analysis for. So, in order to use fundamental analysis, you need to process a lot of information from many different sources to paint a full fundamental picture. And again, they're all different for each different market. So, for example, we have the individual stocks and shares. Okay, so I talked about this briefly on the first webinar. We talk about you got to look at least know what's going on with the balance sheet, the earnings of a company. It's just one number basically. The management team, the general, their products and services, their general market share, mergers and acquisitions that may be upcoming, their price earnings ratio, which again is just one number. The revenue outlook in general, and you could look at analysts and what they say, including myself, about stocks and shares, etc. Now, in terms of that, there's a lot to look at. So, for example, I've been looking at the solar stocks, okay, solar energy stocks, and I've been trading solar energy stocks. And if you take a look at a lot of them, very recently they've been dropping by a lot. And why is that? Well, it could be many different factors. One of which is, generally speaking, energy is going lower, and we see that in crude oil. We see that in other energy products. So you take a look at solar, and you would think, how are they really connected? Well, there's some ways that they're connected, that solar stocks are getting hit hard. Partially because of the decline in energy, as well as other factors. So there's a lot to talk about there. And for example, also there's one stock called Solar City that I've been looking at in the U.S. And they've been declining by quite a lot. 10-20% very recently. And why is that? Well, they just it just came out that they are they're being challenged by a large potential competitor, and that's another thing. So that's another thing to look at. So there's a lot of different aspects to look at with fundamental analysis. And if you're trading individual stocks and shares, it can get harder if you're trading multiple stocks and shares, because basically you're looking at a lot of different things for each individual stock. Okay, if you're trading the indices or the currencies, You know, a little bit less, but still very, very, you know, a lot of stuff to look at. Equity indices. Overall, you want to look at the overall equity outlook, macro factors, including today, for example, you know, in the U.S., the producer price index, which moved the market quite a bit. Interest rates, which are very important, global events and conditions, and sector performance. Commodities, they're all about supply and demand, again, global macro factors and global risk sentiment. So we've talked about commodities, including gold. We just saw a bounce on gold to the upside after hitting key support, and this is the technicals coming in as well. Key support around the 1180 level on gold, and there was a bounce, so basically a triple bottom on gold. So we have yet to see if there's going to be a further rise in gold. But we also look at, and that's all about the supply-demand equation as well as global risk sentiment. And then we also talk about, we see crude oil, and I keep coming back to that because it's just remarkable how low it's going. And, you know, it could have further to go. It just hit a new low today. So you have to look at all of this in order to decide what to trade. Now, some people are saying, how much lower can crude oil go? Is now the time to buy into crude oil? Well, that's very difficult to see. I mean, if you want to use fundamentals to choose an entry, it's very difficult. So if you're looking at crude oil and saying it's pretty low right now, and it's you know, how much further can it go? You're basically trying to pick a bottom, okay, which is usually a very dangerous thing to do, and I'll talk about that a little bit later. And then in terms of the currencies, one of my specialties, again, global macroeconomic factors, interest rates, inflation, especially central bank activities, monetary policy, global risk sentiment, all of that. You see the big announcements a couple weeks ago was the non-farm payrolls report, and that in the U.S., and that turned out very good. And so we saw a big jump in the U.S. dollar, only to turn back around and reverse itself shortly thereafter. So, you know, you really got to keep in tune with everything that's going on, not just one aspect of the fundamentals, but pretty much all of them. And that brings me to why I like to trade using technicals while keeping the fundamentals in mind. Fundamentals are great, again, at giving a rationale for why market moves occur. Okay, every time there's a big move in the market, you're going to see a lot of analysts come out and say why that happened. But you know, first and foremost, we're traders, so we want to be able to react to market movements and use that to our profit. And for me, the best way to do that is through the technicals. So the fundamentals, again, give me a broad picture of what's going on and where the market, you know, may be biased towards. But when I'm looking to actually trade the markets, I'm looking towards the technicals. Okay, so before I get to that, just a quick, Shihab asks, what are the most useful indicators to use? I'm going to go over that. I'm going to go over what indicators I use in a minute. And then let me see. Can an individual trade really make money? Peter asks. Can an individual trade really make money? Yes, it absolutely can. I mean, you could go ahead and trade and you'll see you'll make money. You may lose money, but yes, an individual trade really can make money. Okay. Let's see here. Hopefully I'm not breaking up. If you could still hear me, please type in yes. Sorry to keep asking that. We are having some troubles with this platform. Okay, great. Okay, so let's move on to technical analysis. You know, so this is going to be a lot of information here. For those of you who are true beginners, you're probably going to get confused. For those of you who have been doing this for a while, you're probably going to get bored. So I'm trying to hit the right in the middle of you guys, the people who just have a little bit experience and who don't have too much experience. So those people get the most out of this. It was sort of that was sort of a joke, but Let's move forward. Okay, so technical analysis, same essential analytical factors for each market or instrument traded. So that is the big difference, okay? That's a big difference between technicals and fundamentals. We're looking at one thing here. We're looking at the charts, okay? We're looking at support and resistance levels. We're looking at trends. We're looking at some indicators. I like to use indicators sparingly, but we use some indicators, okay? We look at the same things on whether I'm looking at the euro dollar, or I'm looking at the FTSE, or I'm looking at Apple, or I'm looking at Barclays stock. I'm looking at the same thing. Of course, I'm looking at different charts, but I'm looking at a chart. So we don't need to be looking in all different places. We don't need to be looking for, of course, we should keep the macro economic factors in mind. And if we're trading stocks, we need to keep their economic profile in mind. But when we're trading on a day-to-day basis, especially, I think most of you are short-term traders. If you're trading on a short-term basis, you're going to be paying attention mostly to the charts. Okay, so technical analysis, what is it good for? It's good for determining trends, key price levels, potential price turning points. Okay, it's good for determining trade entries, exits, and risk management, what this webinar is all about. Okay, it's not good. What is it not good for? Determining the reasons for any given price move. Nor is it necessarily good at giving the longer-term directional bias, okay? So we see turns in the market all the time. We see changes in the trend all the time, okay? So the technicals can only tell you where the momentum of the market is, where the key levels are, and where things, could likely happen at those levels, okay, and where the trend is, etc. It can't tell you the reason that anything moved. Okay, if you want to know the reason, you look at the fundamentals. It can't, it's very difficult to tell you the longer-term directional bias. All you could look at with regard to the technicals is the trend. Okay, we have the trend, and markets tend to trend. Okay, so we need to process only information from the charts and chart tools. Now, there are hundreds of available tools that can be used in technical analysis. I mean, hundreds, maybe even thousands. Okay, we on our platform, we have hundreds of technical tools that you could use. Okay, I wouldn't suggest using all of them. I would suggest using only a very small handful of basic tools that have proven to you their usefulness and effectiveness over time. I'm going to give you today what has proven their usefulness and effectiveness to me, but you have to prove that to yourself. Okay, so before you start using these and say James Chen said that this is the tool to use it yourself and see if it works for you. Okay, if it works in the markets you're trading, if it works in the time frames you're trading, if it works for the strategies you're using. Okay, so the tools are only as good as your how you employ them, how you use them, what strategy you use. So again, you have to test these yourself. Okay. Now, here are some of the most simple and effective tools available. Again, I'm starting very basic. I'm giving you the tools I use, very basic tools. Trading is not about complicating matters to make it look like you're a trader. We don't want to look like traders. We want to be traders, right? So if you want to look like traders, you can have 100 different things on your charts, and then everyone that passes by your workstation will say you're a trader, okay? But you're probably losing money. If you are using just a handful of tools that really work for you, okay, including the fundamentals, including the technicals, and you're using them to good effect, then and only then can you be successful, okay? Okay, let's move forward real quick. Okay, candlesticks. Okay, again, I know this is beginning stuff, but very quickly. Why do I use candlesticks? Well, the bar chart, this is a bar chart. This is a candlestick on the bottom. Okay, what's the difference between the two? We always used to use bar charts. Open, high, low, close bar charts. Okay, now every platform you use, including our own, including the Advantage Trader, Advantage Web, as well as MT4, their default is the candlestick. Why is that? It simply gives a better visual representation of price action. Okay, so we have a bar here, same exact information, open, high, low, close. Candlestick. The open will be either on the bottom of the body or the top of the body. We have the same high and low. And the close will either be on the top of the body or the bottom of the body. And this all depends on the color. Okay, so very quickly, if the real body, if this body right here is white or green, depending on your charting platform and your settings, then that means the currency or the market closed higher than it opened. If it's black or red, it means it closed lower. That's all it means, okay? So I'm not going to dwell on this because this is basic stuff. But for those of you, I know there's some very beginners on this, so this is, this is just an overview for you. This gives a good representation. Candlesticks gives a good visual representation of the conflict between the bulls and the bears, and therefore I use candlesticks exclusively. I do not use bars, okay? Because the same information, better represented. Okay. As I mentioned on the first webinar, very quickly over my trade entry and exit principles. One way to enter a trade is the right direction of the best possible price. That is in the direction of the trend. Okay, the momentum of the market, best possible price. I want to be basically trading trading long off of dips and short off of rallies. Okay, that's one of my principles. Okay, I don't want to be buying the market at an all-time high. Okay, or at a significant high. I don't want to be selling the market on a significant low. Not necessarily. Okay, a lot of people do that. They see an all-time high, they get excited. I want to buy this market. Before you know it, it comes back down, and it takes them out of the trade. Okay, same thing if you're going short. A market keeps going lower and lower and lower. Is that an opportunity to sell? Probably not. Okay, probably it's either an opportunity to step aside and not trade at all, or it's an opportunity to buy into the market at some point. Okay, but you need some tools to tell you when is the best the best probability time to get into that trade. So I want to get in the right direction, in the direction of the trend, but at a good price. Okay, two ways to exit a trade. At a loss is where the market's telling you you're wrong. That's how we place our risk management. Okay, so if I buy on a dip, if price subsequently comes down and takes me out of that, takes me out with a stop loss below that dip, that means that it was not just a dip. Maybe it's a deeper pullback, okay, or maybe it is a reversal. Okay, so you want to be able to get out when the original rationale for your trade was wrong. Okay, and that's where we place our stop loss. That's where we place our risk management. Okay, and then we size our position according to where our risk management is. Okay, if you don't know what that means, I'm going to be talking a lot about that in the next few weeks, as well as today. Okay, profit. We want to make it so over time, preferably our trades, our winning trades are larger than our losing trades. Okay, over time. So we don't want to be risking, 5 times to make one time our money. Okay, because that's just a losing proposition. If that's the case, if you do that, if you risk 5 times your money, or let's say if you risk $5 or £5 to make £1, okay, that's really, unless you have a phenomenally stellar strategy that wins almost every single time, and I have yet to see a strategy like that. But if you do that, then you are sure to be a loser. Okay, you are sure to be a loser. If you are, on the other hand, if you're risking £1 for every £2 that you're going for, okay, then you have and especially if your strategy is good, then you have a fighting chance of being consistently profitable and actually doing very well. Okay, so again, preferably at a multiple of your profit, you want preferably at a multiple of your defined risk. And I showed this last time too. I'm going to go over my tools in a second, but this is my market principle. Basically, we're looking for the trend, TPB. We're looking for the trend. We're looking for a pullback. We're looking for a breakout. Okay, so we got the trend. Okay, what's the trend on the euro dollar? Still to the downside. What's the trend on the pound dollar? Still to the downside. What's the trend now on the gold? Well, there's not really a trend on gold. Overall, there's a bearish trend. But we're looking for strong trends to get into, okay? So if we're seeing, for example, today I wrote about pound dollar, okay? Pound dollar, in the morning it popped up a little bit, but then it came back down. It's a very strong downtrend right now in pound dollar. Also on euro dollar, although there was a big rebound today. But on pound dollar, there's a strong trend. We're looking for strong trends, okay? If we're looking for strong trends, when are we looking to get in? After a pullback. We're looking for some type of pullback, okay? if that pullback occurs and then it starts resuming in the direction of the trend and it breaks out, that is the point at which I will enter into the trade. I'm going to place my stop loss, which is this little red thing right here, right under the dip. That's the market telling me that I'm wrong if it takes me out of the position. Okay, so that's my risk right there. I enter on that little blue line. I got my stop loss on this little red line. That's my risk. And then my reward, again, is probably a multiple of my defined risk, okay? And there's my reward. If I keep having my reward larger than my risk, and especially if I have a good strategy that goes with it, then I have a very, very good chance of being profitable, okay, of consistently being profitable over the long term, okay? So that's the market principle. And now let's get to the tools I use, okay? The trend, okay? Number one is the trend. The trend is your friend. Everyone hears this, okay? Is a lot of people say this. It sounds silly after a while, but it's really true. Whether you're looking on a long-term chart, I just said the pound dollar is in a downtrend right now, but on a shorter time frame, I don't know. I didn't look, but it could be on an uptrend. Okay, it could be on a very short-term time frame. It could be on an uptrend. Now, what trend is your friend? That's the question a lot of people ask. Well, it depends on what time frame you're trading. Okay, so I often trade on the daily chart. I look at the big trend. I'm looking at a downtrend. Okay, and I'm looking to sell rallies in things like pound dollar. Now, if you take a look at a short-term trend, it may very well be up. If you're only in the market for 10 minutes during the day, then you see an uptrend forming. Then the trend there is your friend as well because you're trading on a short-term time frame. Now the trend is your friend until the end when it bends. Okay, so that's I don't know where I got that. Someone said that once before, but it's true. Trends, things aren't always going to go up forever or down forever. At some point, the trend may change. Okay, there may be a pullback, it may be a dip, it may be a rally within a downtrend, but it could be a reversal. Okay, and we see that recently happen on the euro dollar where it turned completely to the downside. We saw that on pound dollar. We see I wouldn't be calling this a change in trend yet, but we see these on the indices, big drops in the indices. Okay, in the commodities as well. We see crude oil, as I mentioned, going lower and lower. Now, how much lower can it go? It could go lower, but at some point it's going to bend and it's going to turn back to the upside, okay, or at least consolidate. So the trend is your friend, but until it ends. Now, what is a trend? It's a net directional price move to the upside or downside. Why do I trend trade? Well, it's taking the path of least resistance. We're riding the market's momentum. Now, a lot of people say if you trade support and resistance, if you trade support levels and resistance levels, then you're not trading with the trend. And I say that's absolutely false, okay? If you are trading, you could trade with the trend and use support and resistance levels to guide you in your entries and exits. That's trading with the trend as well as trading support and resistance levels. I'm going to talk about support and resistance in a minute. So why do I trade the trend? Because the trend on the chart is basically giving me an overview of the fundamentals, what is happening in the fundamentals. Okay, so if the euro dollar is going down, okay, or the indices are going down, then it's showing me that something's making it go down. Do I really care what's making it go down? Not really. I want to make money on my trade. Okay, of course I have to keep abreast of what's going on so I know what the fundamentals are saying. But the fact that the indices are going down, the fact that euro dollar and pound dollar are going down, most important to me is that I make trades that make money, not the reasoning behind it. Okay, so I'm looking to follow the market's momentum. If the market's momentum is to the downside, I'm going to look for clues to get in to that market to the downside. Okay. Okay, so for an uptrend, we draw a trend line connecting the lows for support, and for a downtrend, we draw trend lines connecting the highs for resistance. Okay, so here we have an uptrend support line. Okay, this is very simple, very basic, very powerful tool. I'll show you some of my charts in a minute. This is a downtrend resistance line. Okay, that shows a downtrend, we're connecting the highs. In the uptrend, we're connecting the lows. Downtrend, we're connecting the highs. Okay, why is that? Well, these are basically resistance and support levels. Okay, but they're dynamic. They move with the price. Okay, whereas static support and resistance levels are just horizontal lines. I'm going to talk about that in a second. Now, how do we trade off of trend lines? Well, you could do the simplest thing, the most basic thing, the most obvious thing, which is to, for example, here we have an uptrend support line. We look for a dip to the line, and then we look for evidence of a turn back up, and then we buy the market. Okay, you could do that. You could do that on any time frame. Okay, I don't necessarily make it that simple because there's a little bit more to it than that. But a lot of people do that. So for example, you have a strong uptrend line here, and then you have a break to the upside after a dip. Okay, and then you place your stop loss under the low of the dip, just like my TPB, the trend pullback breakout I just showed you. Okay, you play the break to the upside. Okay, same thing on a downtrend. Okay, when it returns to the line, then we can go short on a breakdown below that. Okay, and then your stop loss or your risk management would be above the high of the rally. Okay, that's the trend. Support and resistance, extremely important. Now, what is support and resistance? Support is simply a price floor where more demand may be expected. Resistance is a price ceiling where more supply may be expected. Okay, so support and resistance are derived primarily from past turning points in price. We also use such things as Fibonacci levels, pivot points, and all of that. Okay, but that's a little beyond the scope of this webinar. So support, just think of support as a floor. Okay, of course floors can be broken, and ceilings, resistance is a ceiling. Of course, ceilings can be broken as well. But for the most part, support is an area where you see the market has a lot of demand. Okay, a lot of orders are at that level. Same thing with resistance. Now, unless there's a breakout of support and resistance, we're going to assume that support is a floor and resistance is a ceiling. Okay, so significant price events tend to occur around established support and resistance levels. Rob, do you use the high, low, or the actual close for the line? Okay, if you're, usually I will use the higher low. That's a great question. A lot of people ask me that question, meaning, let's see here. Okay, let's take a look at, let's make this a little bit bigger here. Okay, so here, this is gold. This is a gold chart, okay? Now, if you take a look here, I think Rob's question was very good in that, do you use the close, the bottom of these bars here as your support level or the low? Well, I usually use the low, okay? A lot of people, support and resistance is not an exact science, so some people use the closes, like you would place it right here. I tend to use the lows, and I've just been doing that for many years. That's why I continue to do that. But again, it's not an exact science. But if you take a look at gold, it's almost an exact science. So if you take a look here, the low right here at 11, this was at 1180. We move forward here. This was at 1178, I believe. Okay, we move forward over here. This low just recently, in the beginning of October, was at 1182. So it is almost exact. It is almost precisely to the support level, around the 1180 level on gold. So that was just remarkable. And could it be a coincidence? Yeah, it could. It could. Could all of this support and resistance be a coincidence? It could, but not likely. Okay, because we see this all over our charts. Okay, strong resistance here as well. Okay, very strong support down here for gold. Okay, we take a look at Aussie dollar. Aussie dollar, very strong support right here. Did it go down a little bit lower? Did it dip below? Yes, it did. But very strong support nonetheless. Okay, could there be a breakdown to the downside? Absolutely. Okay, but again, strong support. We see demand at this level. We repeatedly see demand. So it comes down, it pops up. Comes down, pops up. Comes down, pops up. Why is that? We have a very significant low down here back in late January of this year. Okay, this low at 86.59. Okay, it retests it over here. So very strong support right there. Okay, And these are just recent examples, but we see these all over the charts. But great question, Rob. Okay, so so again, significant price events tend to occur around established support and resistance levels. And why do these exist? Why do support and resistance exist? Because of market memory. Okay, traders and market participants remember specific price levels as being relatively too high or relatively too low. Okay, so how do we use support and resistance? We use them as potential entry and exit zones. So we're looking for bounces or breakouts. I know that sounds like a cop-out. It's either going to bounce or it's going to break out. Yes, that's people make that joke all the time. But really, when you take a look at what happens near support and resistance, you get clues as to what it's going to do. Okay, and once you do get those clues, then you could act upon those clues, and then you have your risk management to protect you. Okay, so if it looks like it's going to bounce, if it's bouncing, then it could be an opportunity to go long. If you have other things in place as well, and then you have your risk management to take care of you. If it breaks out, it usually breaks out relatively strongly. Okay, so this is support right here. So support is simply a floor. Okay, so a bounce, a bounce, a bounce, breakdown. Okay, that is support. This is not such a good example of resistance, but it's an example nonetheless. Here we have resistance, okay? So this is a ceiling. So this is a downtrend, actually. And during the course of this downtrend, there are many consolidation areas, okay? This is just one of them. Now, within this consolidation area, there is strong resistance right up here. Okay, this strong resistance acts as a ceiling where there's a lot of supply. So at that point, I'm looking to sell the rallies. Okay, first of all, we have an overall downtrend. Second of all, we have strong resistance right here. So I'm looking to sell the rallies towards that resistance. Okay, and once it starts coming down, I'm looking to go short. Okay, during those levels. Okay, and this doesn't have to be a daily chart. This could be a 5-minute chart. This could be an hourly chart. Doesn't matter. Okay, so you see this type of phenomena all across your charts. Okay, so support is the floor, resistance is the ceiling. Extremely important. Some people, a lot of people, trade off of support and resistance exclusively. Okay, they just look at support and resistance levels, and then they pay attention to the news and all that. But they're looking at support and resistance. They're looking for breaks of these levels. They're looking for bounces off these levels, and they're looking to trade those. And they got their risk management in place. And many of them make a very good living doing that. Okay, pullbacks and retracements. All trending price moves, no matter how strong, will pull back at some point. Crude oil will pull back in its downtrend. Okay, and what do we do when it pulls back? Well, that remains to be seen. Okay, you're going to use your tools to give you hints and clues as to where the possible direction may be, and I'm going to talk about that later. Pullbacks are often the best places to get into a market in the direction of the trend. Pullbacks represent better entries. Risk also can be controlled better when entering a market on or shortly after a pullback. So as I mentioned before here, so what does this mean? So I'm not going to be getting, even if it's, this middle point right here, this high point right here, I'm not going to be getting in long right there, okay? If the market kept going up and up and up, okay, and then hits this high right here, I'm not going to be going long there. Of course, I can't see the rest of the screen, so I don't know what's going on after that. But let's say it hits this high here. I'm not going to go long there because I don't know. Okay, I don't know if it's probably going to pull back. If it's been rising that strongly, it's probably going to pull back. So if it pulls back and then it starts turning back up in the direction of the trend, then that is a potential indicator for me to get into a long trade. And of course, again, I have my risk management to take care of me. The risk management would be right under the low of this pullback, which would tell me that that my original rationale for getting to the trade is wrong, and therefore I should be getting out of the position and hopefully a small loss, okay, at a small loss, and then I'm going to be going for a bigger profit to the upside, okay. That's pullbacks and retracements. Ranges, we often see ranges. Where do we see ranges? Let's see. Not a lot is ranging these days, but if we take a look at, not a lot is ranging. You could say gold is ranging a little bit, but not a lot else is ranging. Right now on a shorter term basis, Aussie dollar is in a range. Okay, there was a prolonged range up here, as we can see. Okay, and that was back here was a really good range in Aussie dollar. This is sort of ancient history, but this was back in 2013. There was a prolonged range which was very good for going long at support, short at resistance. Peter asks, do you use fibs to decide to enter? Yes, fibs are one of my tools, not my main tool, but one of my tools. Now let me show you how fibs work. And I'm going to get into fibs in a second. The fibs are simply Fibonacci retracement levels or Fibonacci extension levels. Lots of different types of Fibonaccis, but here's one of them, okay? So here's the Fibonacci on euro dollar. So here, I measured from the high here to the low down here. It retraced to the 38% level, which is a very key Fibonacci level, okay? Let's see what else. Okay, well, I drew this line from here, down here, the low of the uptrend, down to up to the high of the uptrend, and the pullback. It pulled back, but it didn't go further. It was at the 38% level. So 38%, 50%, 61%, 62% are all key levels for Fibonacci retracements. Okay, but I think I'm going beyond myself right now. Okay, so ranges. What are ranges? They're a lack of trend, sideways price movement. We could always trade ranges, okay? Long near support, short near resistance. There's no clear directional bias. These are the best times to range trade. If we see a range during the course of a strong trend, I'm probably not going to be trading within that range. Why? I'm looking for a continuation of the trend, usually, okay? So, for example, if pound dollar has been going down a lot, right? Pound dollar. So here we see pound dollar going down. Now let's say a range forms where it just goes up and down, sort of like it's doing right now. Okay. Now, am I going to go long when it goes lower within this new range? Probably not. Okay, because I know that the overall trend is to the downside. And I'm not going to be trading this range to the upside. I may be trading this range to the downside, okay, but not to the upside. I just am not a counter trend trader. That's not to say trading against the trend is a bad thing. A lot of people do it, but I am not a counter trend trader. I don't like to trade against the momentum of the current market. Okay, so at this point, again, I'm not going to go long on pound dollar. I'll either stay out of any trade or I'm going to go short. Okay, so resistance at the top of a range and support at the bottom. This is what a range looks like. This is what a range looks like. You're looking for opportunities to go long near support, short near resistance. Very easy stuff. Okay, it's just support and resistance. But again, I don't like to go against the overall trend if there is an overall trend. Okay, bounces and breakouts. Once again, as I mentioned, we're looking for either bounces or breakouts. Okay, the joke always goes, there's either going to be a bounce or there's going to be breakouts at a certain support or resistance level. Now, what happens at those levels? Well, that's what we're looking for, bounces or breakouts, okay? And these can always be used for trading purposes, okay? So the question is, where would I get in on a bounce? Okay, so a lot of people say, oh, you're going to get in right at the bottom of the bounce, okay? Like on gold, I was going to get in right at 1180, right? Well, I'm not that smart, okay? And I'm not that I'm not that reckless. Okay, so I don't know what's going to happen at support or resistance. Something likely is going to happen. Okay, there could be a bounce, or there could be a breakout. So I'm going to wait to see. Okay, I'm going to wait to be confirmed. So once there's a bounce at support, okay, I'm going to wait to be confirmed on this with a move to the upside, and I'm going to be using some of my tools to give me additional indications that in fact a bounce is taking place. If there's a breakout, just the opposite. Okay, I'm going to be looking for the breakout to occur, and then I'm going to be looking for a filter to get in after the breakout occurs. I'm not going to get in on a breakout right at that support level, because that would be reckless. That would be folly. Yeah, you would be getting in very early on the trade, but you have no confirmation, and I'm all about confirmations. Next week and the week after, I'm going to be talking about something called confluence. Confluence is simply confirmation. You want confirmation that something is occurring in order to get into a trade. Okay, Eric, what do you define as a change of trend? There are many ways to define a change of trend. Okay, one way is to look at Fibonacci levels. Okay, one way is to look at breaks of key support resistance levels, and another way is to look at moving averages, and another way is to look at trend lines. So I sort of put everything together. Again, I talk about confluence. If I see a break of a trend that's breaking down, let's say. Let's take a look at the, for lack of a better example, let's look at euro dollar again. So how do I know this trend was changing from an uptrend to a downtrend? Well, I didn't know. Okay, I didn't know, but there's several different clues to tell you. Okay, first of all, we saw the breakdown to key support at 135. Okay, it hits 135, and then it pops back up to the 38% Fibonacci level, right around key resistance at 137, and then it moves down from there. Once that breakdown occurs, then I'm looking at a new change in trend. Okay, I have the 50-day moving average cross below the 200-day moving average. That's yet another sign. Okay, so I've got several different signs. Now when it popped back up to 137, it not only hit the key 137 level, and it hit the 38% Fibonacci level, but it also hit the 200-day moving average. Okay, so this is a key confluence of resistance here. Once that started moving down from there, then I'm thinking this could be something that, this move could have legs. Once it breaks down below 135, then I'm looking at a change in trend. Okay, so at that point, that was a confirmation of several of my different tools telling me that there's a breaking trend. Okay, great question, Eric. Lorraine, do you wait for the next candlestick after the bounce? Yes, I do. Yes, I do. And I have a strategy that I'm going to talk about 2 weeks from now, where I talk about getting in on the next candlestick. Okay, after the bounce or after the breakout, getting on the next candlestick, because usually that is a good confirmation of continuing momentum in the market. Okay, great question as well. Okay, so let's move forward real quick. Fibonacci ratios. Fibonacci is based on the golden ratio, mathematical structure that occurs throughout science, nature, and even financial markets. Now, the key ratios for Fibonacci include 38%, 50%, and 61.8%. Okay. Now, do I believe in magic numbers? As I mentioned last time, no, I do not. Okay, but we see turns in the markets all the time at 38%, at 50%, at 61.8%, all the time. Okay, is it a coincidence? It very well could be. But why are we looking? Why do I look at, even if I don't believe in magic numbers, why do I look at these levels? Well, simply because they are looked at by many traders, many large traders, many small traders, many institutional traders, many retail traders. They're all looking at not just this. I mean, this is a small part of it, but a lot of them are looking at these levels and acting upon these levels, and therefore we have what's called a self-fulfilling prophecy oftentimes at these levels or near these levels. Okay, so it's a part of my toolbox, not the main thing, not by a long shot, but it's part of my toolbox. Peter asks, how do you know which level it will continue? You don't. Okay, great question, Peter. How do you know which level will continue? How do you know it's going to turn at 38.2%? How do you know it's going to turn at 50%? You don't. Okay, therefore you have to look at the confluence. Okay, so again, as I mentioned here, how did I know it would turn at the 30 on euro dollar at the 38%? I didn't know that. Of course not. Okay, if I knew that, I would be I would have made a lot of money just playing the short right there. Okay, I didn't know that. It could have turned at the 50. It could have turned at the 61.8. It could have turned at none of these. Okay, but a clue was that it turned at the 38. And it turned down at the 38. It turned down at the 200-day moving average. It turned down at the 137 level. And that was a clue. Once it started moving to the downside, then you got some good clues that this is a bearish market. Okay, this is starting to be a bearish market. And then you could you could plan your trades accordingly. Okay. Okay, so again, you don't know, but oftentimes they turn at these levels, and then you have to look for clues once they do turn at these levels, that is some other indicator also telling me the same type of thing. Okay, is something else telling me the same type of thing, and then I've got confluence, and again, I'm going to talk all about confluence. Okay, moving averages. Moving averages can give you trend indications. You hear in the news all the time, in the financial news, people talking about, oh, this just broke its 200-day moving average. Well, the S&P 500. just broke its 200-day moving average, which is a big thing, for not only for just technical analysts, but it's a big thing for everyone trading, because it's sort of a benchmark. You got the 200-day moving average, which is simply a measure of the last 200 days of price action, and the fact that it broke down below it was a big deal. Okay, so now on the S&P 500, by the way, we are in or almost correction territory, which is often deemed 10% or more pullback. Okay, in the market. So it broke down below the 200-day moving average, and it went down further, and now we're nearing correction territory. So moving averages can give you some kind of a benchmark where a lot of people say if it's above the 200-day moving average, then it's bullish. If it's below the 200-day moving average, then it's bearish. I don't exactly subscribe to that, but but it makes some sense. I mean, the moving averages give some indication of the relative highness or lowness, if those are words, of of the market. Okay, and I use these a lot, as you can see on my charts. Okay, oscillators. I'm not going to really go through these, but I use stochastics and MACD all the time. Okay, they give indications of overbought or oversold, and they provide just an additional indicator in my confluence. Okay, just like the moving averages and the Fibonacci levels and the candlestick patterns, etc. They give me some indication of where price may be, if it's completely oversold, if it's completely overbought, or if it's somewhere in the middle. Okay, and Peter asks, which one is your favorite? Okay, stochastics is usually my favorite. Stochastics, and oftentimes I'll use MACD as well, but usually stochastics is my favorite for many reasons, only because I've been using them for many years, and they tend to work very well with the strategies that I use, which I'm going to introduce next week and the week after. Okay, those are oscillators. MV, I'm not sure what that is, Peter. Okay, so basic candlestick patterns. Okay, wow, this time went by really quickly. I've got a lot more material. Okay, so we're just going to go forward a little bit further, and then moving average favorite. Okay, Peter, great question. I tend to use, as you'll see all of my charts, also on here. No, I don't have it on here. I have the 200-day and the 50-day. Okay, 200-day and 50-day are usually my standby moving averages, especially on the daily chart. Why? Because a lot of people look at the 200-day moving average, whatever market you're looking at, and also the 50-day moving average is a shorter-term average that a lot of people look at as well. And I like to be looking at what a lot of people look at. Just like that's the reason that I'm looking at the Fibonacci's as well. Okay, so you've got the 200-day and you've got the 50-day, and I'm looking at both of those. Okay. Also sometimes a 100-day for the daily chart. Okay, basic candlestick patterns. Okay, suffice it to say, my favorite ones are the hammer and the shooting star. Why is that? Okay, so what is a hammer and why does it matter? Well, a hammer is simply a candlestick that follows a down move. So we have price move down, all the way down, and then all the way back to the upside. Okay, so then price gets rejected, and then it moves back to the upside. Okay. So that talks about failure or rejection. If this occurs near a support level, then that's a pretty strong indication that there might be a bounce, okay, and a pop to the upside if you're looking to go long. Okay, same thing to the downside. We have a shooting star candle, which means price is going up and then goes all the way up and comes all the way back down on the last candle. Okay, and this talks about rejection or failure. If this occurs near a resistance level, it's a very strong indication that perhaps price could be moving back towards the downside. Okay, and if that's the case, that's an opportunity. If you were looking to go short anyway in a downtrend, you're looking to go short on a rally, this would be a good place to do it on a shooting star. Okay, so hammers and shooting stars are especially strong indicators that I use in my toolbox along with everything else to help me decide where to go long or short. Okay, you could use this on the 5-minute chart, on the 10-minute chart, on the on the 30-minute chart, on the daily chart, what have you. Also, doji, talk about indecision. Oftentimes, they're turning points in the market. Okay, so you'll see that in a lot of different places. Okay, we have bullish engulfing patterns, bearish engulfing patterns. Okay, James asks, I'm not going to be ambitious and try to finish everything I have today because it's, we've pretty much run out of time. I'm going to go over some of this next time. The rest of this, it's not much left, but I'm going to go over this next time. What makes the candle move to the right to the other candle? What makes the candle move to the right to the other candle? James, I'm not sure what that means, but if you mean what starts this candle here on the hammer, it's the end of the prior candle. But I'm not sure if I answered that question. So let's move forward real quick. So bullish engulfing patterns, bearish engulfing patterns, they're also turning points within trends. Okay, so oftentimes I'll look at my chart if I'm looking to go long or if I'm looking to go short. I'll look for either a hammer or a shooting star, or a bullish engulfing or a bearish engulfing pattern to help confirm that move and perhaps to get into a trade. Okay, yeah, I think I've run out of time here. We're gonna let's pick this up on chart patterns next week, and I'm going to show you simultaneously my strategies for trading, my basic strategies for trading using all the tools I introduced today, as well as next week, and then we'll move forward from there. I had a lot of material today, but we'll fit this into next week, and then we'll talk more about exactly how we use these tools to trade in the markets. Okay, so for now, thank you very much for attending this webinar, and we will see you next time at the same time. Thank you very much.